A few days ago, I came across this great article by The Visual Capitalist. It talks about some of the most common investment mistakes that people are making. Now, this is actually based on a report by CFA Institute called Tips for Avoiding the Top 20 Common Investment Mistakes. I found this article and the report quite helpful and thought about making a video on it. So today, let's look at these common mistakes that every investor should be avoiding. I believe whether you're a beginner or an intermediate investor, you should find this video quite helpful. Remember, the best way to invest is to make informed decisions and avoid the most stupid mistakes that people make. I hope you find this useful. Let's begin. Let's start with mistake 1, expecting too much. It's quite common for beginner investors to start expecting too much too early. A lot of these expectations are actually above 15%, while even professionals typically anticipate a modest return of around 7%. The reality is somewhere in between, with even the S&P 500 returning an annual average of 10%. Yes, it's an average, but it's extremely hard to beat the S&P 500 over the long run. It's important for us to set realistic expectations and make sure that we are at least in line with the historical performance of the market. Being realistic will help guide your investment decisions in a rational way. Mistake number 2 is not having investment goals. Did you know that 40% investors don't have a long-term goal and focus only on the short term? If you're one of them, this lack of direction can make you take impulsive decisions again. Without a clear long-term goal, it's quite difficult to survive the market fluctuations which come every day. You need to understand your risk tolerance and take a balanced approach to investing for the long run. The best way is to set smart goals. It's these kind of goals that provide a roadmap for success, guiding investment decisions and providing a benchmark against which to measure progress. Market fluctuations will become a piece of cake if you know where you're headed and stay the course. Mistake 3 is a common one, which is lack of diversification. As we all know, diversification is a key strategy for managing risk. Yet, it's quite common for all of us to sometimes become way too allocated in one sector or one company. We have all heard about people going all in on one stock. But always remember that only 20% of the companies can beat the S&P 500 over the long run. This underscores the importance of spreading your investments across different companies and sectors and even different asset classes. Overallocation can expose you to too much risk and mess up things in the long run. Mistake 4 is also quite common, that is focusing on the short term. While short-term gains can make you feel great, they often come at a price. Please note that we are not talking about short-term actions such as swing trading. We are talking about investing here. Generally speaking, if you invest in a good company, you want to stay with it for the longer journey. Ask any long-term Nvidia investors how much pain they had to endure before getting those massive returns. Short-term investments are not bad, just make sure you know what you're doing and balance it out with the long-term investments. The fifth mistake is a funny one, buying high and selling low. Yes, this is the meme we are all aware of in the investing world. So let's look at why does this happen? Why do people buy high and sell low? There are two primary reasons for this. The first one is fear. Fear can play a big role, especially if you don't know what you have invested into. And let's be real, a lot of people don't do their due diligence when it comes to investing. The second reason is chasing hype. Let's say you bought into a stock and now the stock is down and you see another stock going up. You immediately sell out of your position at a loss and get into another stock which was already hyped up. And people who don't understand what they are doing are doomed to repeat it again and again. As stupid as it sounds, I see people doing this all the time. And this is why having a well thought out plan is important, and always keep your emotions out of the markets. Don't get attached to companies, don't chase hypes, and always stay the course when it comes to good companies. Market fluctuations are just part of the game. Learn to live with it. Mistake 6 is a follow-up, that is trading too much. Did you know that on average active investors underperform by 6.5%? There are also studies that show that only about 1% of traders consistently beat the S&P 500 over the long run. It might be fair to say that it's quite hard for an average Joe to come in and beat the S&P 500 over the long run through active trading. The main reasons for underperformance can be attributed to transaction costs, poor timing, and difficulty of consistently making accurate market predictions. Nobody knows what's going to happen, and not everybody can keep their emotions out of the market. Overtrading can also lead to stressful situations, so try to avoid it as much as possible and focus on the long term and investing. Even if you want to start trading, start with a small amount and see how good you can get with it. And if you do become good with it, make it part of your plan. Mistake 7 is paying too much in fees. This is often an underlooked fact, but a lot of people lose money due to high fees. ETFs, for example, come with management fees that are automatically deducted from the fund's assets. These fees can vary, but the average expense ratio is somewhere around 0.3%. Yes, this is quite low, but make sure to account for it over the long run. Fees come into play a lot more when you're working with financial advisors who are charging you 1 to 2%. This is incredibly high, so make sure you can justify it with great results. When in doubt, turn to the S&P 500 ETF and ditch your financial advisor. And this is not financial advice. Make sure to do your own due diligence when it comes to your financial advisor. We will actually come back to this point in a bit. Mistake 8 is focusing too much on taxes. Generally speaking, you should make use of any tax sheltered accounts that you might have access to in your country. Where you have to be careful is when it comes to things like tax loss harvesting. If you are invested in a good company which is currently in losses, try to not get rid of it just to tax loss harvest. An example of this could be you selling out of a company for tax loss harvesting and missing out the potential gains over the long run. While tax loss harvesting can be a key strategy, just don't make abrupt decisions. What I mean is don't miss the forest for the trees. Mistake 9, not reviewing investments regularly. An effective component of investing is to review your performance and portfolio regularly. If you are investing on your own, make sure to benchmark it against the S&P 500. This becomes even more important when you have a financial advisor or somebody else managing your account. Always make sure you know how you're performing against the S&P 500. The reason is that if you're not beating the S&P 500 over the long run, you might as well buy an S&P 500 ETF. Mistake 10 is misunderstanding risk. When it comes to understanding risk, there are two things: how much risk you can personally tolerate and how much risk your portfolio can tolerate. Just because you can stomach a lot of risk does not mean your portfolio can handle a lot of risk. On the other hand, if you don't take on a little bit of risk, you may not even beat inflation. Just make sure you have a good understanding of risk to reward of your investments. Mistake 11 is not knowing your performance. This is something we just spoke about when we were talking about reviewing your investments. Let's re-highlight a couple of things. First is to always review your performance against the S&P 500. This becomes even more important if you're managing your money through somebody else. You should not be losing 1 to 2% of your portfolio to fees and not beating the S&P 500 at the same time. If I was in such a situation, I would just ditch everything and invest in the S&P 500 ETF. Also, as a tip, make sure you're doing some quarterly and yearly reviews of your performance. This can become quite easy if you use an investment portfolio tracker. Mistake 12 is something I really hate and had to learn the hard way, that is reacting to the media. The media tends to focus on the negative news when the markets are down, which are essentially the best times for buying. Then they flip the script on you when things are extremely overheated and hyped up. They keep giving you positive news about how things can never come down again. I have learned it the hard way that the easiest way to lose money is to listen to the media. At this point, it's quite obvious that the mainstream media's job is to work against you. This is especially true when it comes to the world of investing. Fear sells, and that is what the media tries to do. If you have done your due diligence, it's quite easy to ignore all the negativity around certain companies. And the flip side of this is true as well. If you see a lot of hype and a lot of attention going to something, try to stay away from it. It might be a good investment, but it might be the worst time to be buying into it. The perfect example of this was all the mania phases we saw in 2021. I can talk about this all day, but let's move on to mistake number 13, that is forgetting about inflation. This one is very important for anybody who's not investing today. Did you know that the average inflation is about 4% annually? This can significantly erode the purchasing power of your money over time. For instance, $100 today would be worth approximately $96 after 1 year, and after 20 years you would only be left with $44. Now, you will actually have $100, but what's going down is your purchasing power. Therefore, not investing or making less than 4% is actually devaluing your money. Mistake 14 is trying to time the market. Generally speaking, apart from the most euphoric stages, it's extremely hard to try and time the market. Trying to time the market can lead to missed opportunities. For instance, investors who stayed in the market have generally achieved higher returns than those who tried to time their entries and exits perfectly. Instead of trying to time the market, consider strategies like dollar cost averaging. Here's a quick example of what can happen over the long run if you just dollar cost average into the S&P 500 over the long run. Mistake 15 is not doing your due diligence. Again, this is quite obvious. If you invest into things that you don't truly understand, you might make mistakes when the times get tough. This is becoming more and more important because of how much information is out there and how much buzz is on social media. You can follow a ton of people who'll say lots of things about different investments, but it's extremely hard to know what's true and what's not. The only way around this is to learn some fundamental analysis so you can know yourself which companies are good buys. Remember, the more diligent you are, the more likely the outcome will be positive. And there are plenty of tools available nowadays to do your research. Mistake 16 is working with the wrong financial advisor. I'm not against financial advisors and I do not have one, but if you are somebody who's choosing a financial advisor, make sure you do your due diligence. A good advisor should align with your goals, communicate openly, and prioritize prioritize your interest over theirs. This can be very hard because financial advisors will make money whether or not you make money. The only thing I can recommend is that you ask your financial advisors for their performance over the years. It again comes down to whether or not they can beat the S&P 500, or you might be better off just buying the S&P 500 ETF. Considering how few fund managers actually beat the S&P 500, the odds are likely to be against your financial advisor as well. Yes, a financial advisor can be very important if your money situation is complicated or you're running a business. But if you're a simple person with simple needs, make sure you make the right decision. Again, always do a background check on the firm, broker, or the financial planner you're working with. Mistake 17, which we already touched upon a little bit, is investing with emotions. This is something that is very prevalent in the markets, that is emotional investing driven by fear and greed. There are even trackers for this when it comes to S&P 500 or even Bitcoin. Again, things like fear and greed can cloud your judgment, leading to you buying tops and selling bottoms. A good way to understand emotional investing is by studying the Wall Street cheat sheet. This is my go-to chart whenever I feel like I'm getting some FOMO. Data shows that 90% of investment decisions are influenced by emotions, emphasizing the importance of controlling impulses. Your job should be to become a part of the 10%. Yes, this can take a while. This discipline can only be built over the long run. Mistake 18 is chasing high-yielding investments. You know what they say, if something's too good to be true, you gotta be careful. This is especially true when it comes to money and investing. We can often get sucked in with investing opportunities that seem very attractive. If you have dabbled even a little bit in the DeFi world, you know exactly what I'm talking about. But keeping crypto aside, you can also find such opportunities in the stock market. Generally speaking, if you find a very high dividend paying stock, it's likely to come with some risks. Your job is to make sure that this risk reward makes sense. Again, if you're looking at a long-term investment, maybe the short-term risk is not that important. Just make sure you understand what you're getting into. It's important to understand that sometimes high dividends are a trade-off for innovation. Just understanding all dimensions of risk will help you take more informed decisions. Whenever something or someone guarantees you high returns, that's when you should be careful. In the markets, there are no guarantees, only probabilities. Mistake 19 is again a basic one, that is neglecting to start. There are still way too many people waiting for the right opportunity to invest, losing their money to inflation. The power of compounding is extremely important when it comes to investing. Consider two people investing $200 monthly, assuming a 10% annual rate of return, which is in line with the S&P 500. Let's say they invest until the age of 65. Let's say the first person starts investing at the age of 20. They'll have 45 years to grow their money. By the age of 65, they'll have over $1.8 million. And let's say the second person starts at the age of 35, giving them only 35 years to grow their money. They will only have close to $700,000. That's over $1 million of difference. And that example demonstrates everything you need to know about starting early. The last mistake is not controlling what you can. This one brings everything together. Nobody can predict markets, but you can control your own actions. By keeping your emotions aside and ignoring market fluctuations, you can build significant wealth over time. This has again brought us to the strategy known as dollar cost averaging. DCA can reduce the risk of making a large investment at the wrong time and also help you stay the course. If you go through the mistakes we just spoke about, you'll understand what you can control and what you cannot, so make sure you're making the right decisions. I liked what Visual Capitalist wrote about this. Building a solid portfolio often involves assessing the following factors: financial goals, current income, spending habits, market environment, and expected returns. While you can't control everything, you can at least understand everything. And that's the formula for long-term success. And that's it. With that, we have covered all the mistakes that CFA Institute has put together. If you found this video useful, make sure to like, share, and subscribe. Remember, making mistakes is part of the investment journey. What's important is to understand some of the most common mistakes so that you can avoid them. And if you make some mistakes, just learn from your experience and move on. Again, always focus on the long term. I'll be back next week with a new video. Till then, keep learning and stay on top of your finances. Until next time.